everybody. Welcome to the Financial Services Council ReGenerations Conference 2021. We've had some fabulous sessions so far, and today will be no exception, I'm sure. So today we are talking about reverse mortgages. Are they the solution to our retirement housing crisis? And I would just like to start by thanking our sponsors, without whom this conference would not be possible. In particular, today's sponsor, Trustees Executors. My name's Liz Coe, and I have been a financial advisor for over 20 years now. I specialise in retirement planning, and I have to say, during my years as an advisor, I have seen a lot of people who are in that situation of being asset rich and cash poor. So I'm really excited about today's event to see if we can come up with some solutions for these people. And, you know, we've all seen over the last few years, we've had rapidly rising house prices. So a lot of our baby boomers have most of their wealth tied up in their home, and they're thinking, well, wouldn't it be absolutely wonderful if I could access some of that? We've also seen Massey University's retirement expenditure analysis, which shows that for people living in cities in particular, they might need something like $100 a week over and above their NZ super for a couple to live a reasonably comfortable retirement. And I know that there's been record numbers of applications for reverse mortgages in the last wee while. So I guess the big question is, are reverse mortgages a good idea, or are there other solutions that might solve this retirement housing crisis? So I would just like now to invite the other panel members to join in. And I'd like to introduce them. So we have, first of all, Professor Graham Squires. So Graham is the doctoral supervisor in Massey University School of Economics and Finance. He's an international economist, geographer and planner with expertise in property and housing. He's the author of 6 books. He's written over 100 peer-reviewed journals, conference papers, grant-funded reports and book chapters. He's lectured at the University of Manchester, University of West England, Bristol, and Birmingham University. He's the visiting scholar at the University of California, Berkeley, University of Illinois, and Delft University. President-elect of the Pacific Rim Real Estate Society, council member of the New Zealand Association of Economists, CEO of the Property Foundation, and a Fulbright scholar. Wow, we have got some fabulous panel members today. We also have Josh Funder. Josh is the CEO and Managing Director of Household Capital, who provide home equity release in Australia. Josh was a director of biotech companies Celadon and spent over a decade as a partner in GBS, which is Australia's largest venture funds management firm. He previously worked at pharma company Infinity in Boston and at the Boston Consulting Group in San Francisco. Josh is a co-founder and former chairman of Per Capita, an independent progressive policy think tank. He earned a BSc and LLB degrees at Melbourne University and an LLM degree at the London School of Economics at Melbourne University, an LLM at the London School of Economics, and a DPhil in intellectual property for biotechnology from Oxford University, where he studied as a Rhodes Scholar. Wow, fabulous. Lisa Hatfield joins us from Heartland Bank, where she is the reverse mortgage team leader. She's a born and bred Kiwi. Lisa returned to New Zealand in 2015, following an extensive international business career, including 10 years in the reverse mortgage industry in the US. Lisa is passionate about home equity release and also using her experience to educate the New Zealand retirement planning market about how this option can help Kiwis in retirement. And finally, we have Ralph Stewart, who was CEO of AXA Insurance in New Zealand for 9 years, more recently the CEO of ACC. He has 30 years of experience in New Zealand's financial services sector, including 8 years as GM of marketing and strategy at Tower Insurance. Ralph holds an MBA from Manchester University in England. So what a fantastic panel we have. If these guys can't solve our retirement housing crisis, I don't know who can. So we're looking forward to hearing what you all have to say. Now, just a little bit of housekeeping. You do have the ability to put questions in the chat box, and we may take some of these as we go through, but more likely we'll reserve 10 minutes or so at the end of the session, and we can get the panel to answer these. So when you post your question, if you wouldn't mind, just, if you have one that's directed at a particular panel member, then please note that in your question. Right, so let's kick off by just setting the scene. So we want to spend a few minutes now talking about what is the problem we are trying to solve here. What's the background? Why do we have a retirement housing crisis in New Zealand? And what are some of the some of the semantics around that? So I'm going to call upon Graham to help us set the scene. What's the scene in New Zealand around home ownership rates and ageing here in New Zealand? Over to you, Graham.
Cheers. Thank you, Liz. Okay, so I'll just kick off by thinking about issues of ageing population and make some connection to housing. So we'll start to set the scene. I've got a few statistics that we can fire into as well. I mean, let's start thinking about sort of internationally and globally about ageing population. It's certainly ageing population is a global phenomenon. We certainly see projections showing that within the next decade, 1 in every 8 of the world's population will be over the age of 65. So that's what the United Nations 2017 statistics are saying. So 1 in 8 of the world's population will be over 65 years. And broken down regionally, that's all across the board except for Africa. All other continents are aging at a higher rate than the global average. And then we start to sort of transpose that to the New Zealand experience, and we can draw a lot on what's happening in Australia. Certainly in relation to banking and housing markets that have taken a similar trajectory. So if we make comparative analysis, we're seeing similar structures in terms of aging populations, conversations that we'll have about the boomer generation that's has a higher proportion of asset wealth in property. The structure of the housing market, a fragmented mum and dad owner and investor market. But also allied with that is a home ownership tenure that's declining as well, largely due to issues over affordability. Similar banking ownership structures between New Zealand and Australia, and similar patterns in terms of overheating housing markets. So New Zealand can draw a lot from Australia, and there's a lot of academic research that's coming out of Australia that I'm working on. I'm doing some pieces on reverse mortgages and on retirement villages. So that's why I'm sort of here and really interested in the conversation and being part of the conversation and adding a lot of my interest in housing and housing affordability to it. So in terms of Australian statistics, projections in some of the papers, by 2061, older people above 65 years will constitute a quarter of the population. So it's in Australia, a quarter of the population above 65. And those over 55 years, it will be a third of the total Australian population. Further estimated the number of vulnerable older people, those that are aged 85 years and over, will double to over 1 million people over the next 20 years. So this is all figures from the Australian Bureau of Statistics. And I think allied to this, and part of the conversation we'll have today, is that younger age cohorts are declining at the same rates. So as well as thinking about an aging population, thinking about the younger cohort that's declining as well. We see sort of data for Australia showing that, in the big picture, 1901, we see 35% of the population were under the age of 15 years. Whereas in 2015, that percentage had declined to 19%. So a shift from 35% to 19% in terms of those cohorts under the age of 15. And by contrast, in 1901, we see 4% of the population was over 65. And by 2015, we'd seen that grow to 15%. Reasons behind this, I suppose that's no big leap of imagination. It's reasons around declining fertility and increasing longevity. So we're all living longer. So got the big aging population picture, and we're going to overlay on that ideas around housing. Certainly the Australian housing statistics and links to housing. I'll throw some more statistics at you. You know, a substantial majority of older Australians, that's 71%, own their own primary residence outright, as opposed to younger generations at 19%. So 71% of older Australians own their own home, as different to younger generations at 19%. We see a home owning population creates the opportunity for what's referred to in the literature as asset-based welfare. A system where older people can release home equity to provide financial support in later life stages. So there's a lot of conversation about asset-based welfare, whether this is, you know, reverse mortgages as a supplement to asset-based welfare, and thinking about life courses and how people change their financial support needs in later life stages, you know, particularly when health needs are at a higher level. You know, we also see, you know, several older people, presumably in retirement, still need to service a mortgage, and that's no doubt going to increase in the number that have to service a mortgage in older life. And also we see the possibility of financial hardship in later stages of life as mortgage and rent obligations increase, with no correspondent increase in income. So as we sort of see the rollout of the baby boomer generation and the wealthy baby boomer generation, how that might fall into decline, a greater, you know, how the generation rent feeds through as the baby boomer generation starts to wither and age. If I've got 2 seconds, I'd like to just show you a couple of graphs that will hopefully sort of illustrate the points that I've just put forward. So here, so we're looking at those international and global statistics, picking out Oceania in pink there, you know, sort of high up the tables in terms of proportion and age 60 years or over as a percentage. Illustrating in this second graph, this extra key point in terms of an aging population, but also that younger cohort as well. So we're starting to see that divergence there. And then thirdly, this is a sort of an interesting graph that's related to tenure and ownership. We look at the first graph, which is 0 to 64 years, and the second bar chart at 65 plus years. You know, a massive difference in terms of outright ownership in those 65 plus, you know, that 71% that I mentioned in relation to the 19% in those blue columns. So that's a nice, interesting visual there to see those differences. So there's some of the introductory sort of aging population related to housing. Also, I've got some good points here that I can talk through in relation to reverse mortgage as well in this particular study. And then I'll pass over to some of the rest of our guests. But hopefully this acts as a nice primer. In the study on reverse mortgages in Australia, there was sort of some of the findings were basically negative views, positive views, neutral views on reverse mortgages, and this sort of will help some of the pre-thinking here. Negative views that came forward was you know, this people's desire to avoid debt, full stop, and this, you know, will obviously layer more debt into the picture. Concerns over a diminished estate, concerns over no money at the end, concerns that there won't be an asset, and there's a concern and worry that people will lose their house. Secondly, in terms of negative views relating to the nature of the product, interesting terminology like dangerous, disgusting were some of the respondent comments. Don't like them. Concerns over high interest and fees. Is it a scam? Concern over some of the terms and conditions and alternative uses that can be used. So that's sort of, as a product, sort of some of the challenges for reverse mortgages. Positive responses, you know, this point that was made at the start there, Liz, about, you know, being asset rich and income poor. The positive ability to avoid burdening others. You can use it as if your circumstances change, gives you ready cash, and just sort of general thoughts that it's a good idea. And then finally, before I sort of pass over, the sort of more neutral views really in terms of circumstances not being suitable to use reverse mortgages. You know, concerns about not being able to sell one's house, or people just not having a need for it. And then finally, sort of neutral responses related to not being familiar with reverse mortgages. And I suppose we can talk about the knowledge gap. Economists will talk about behavioural concerns, and behaviours are sort of underpinned by knowledge and education. So, people's neutral sort of responses about, don't understanding what a reverse mortgage is, and basic things about how you pay them back. So that was some of the research that underpins these ideas around what the product is, positive, negative, neutral, as well as sort of putting forward some of those international Australian statistics and how that might be considered in New Zealand.
Thanks, Graham. That gives us a really good basis on which to have this panel discussion. Some really interesting statistics there. And I would just like to add, just anecdotally from what I've seen with talking to clients, I've just observed a societal change, if you like, in the sense that there's a lot of people now coming to retirement having experienced a lot of negative events, such as relationship breakdown, redundancy, mental health issues, businesses going under, all sorts of things which our parents didn't really, suffer from. I think there is a change in society that's led people to the point where they no longer maybe own a home or perhaps have a mortgage still because of these things that are happening in society that have impacted them negatively. I'd just like to invite any other panel members who would like to add to this discussion around just the general background in New Zealand on home equity. Anybody else like to throw in some comments there?
I'd have probably three. The first is there is an ageing population. Nations make a deliberate choice whether to seize that as an opportunity or to consider it a burden or a threat or a challenge. It's a reality. I think Australia has done some good work to understand the opportunity to live 30 years in retirement as an opportunity, unprecedented, but the need to restructure around that. So it's a very different policy and attitudinal setting if you think that ageing is a fantastic time of life, but something we need to support with the right housing and funding. The second thing I'd say is ageing isn't just a housing challenge, as the topic of this panel would suggest. It's a funding challenge. The funding structures for ageing are very different around the world, particularly between New Zealand and Australia, and getting pension, superannuation, private investment and home equity working for retirees. Australia's made a lot of progress. The Retirement Income Review recently added home equity as the third pillar of our Australian retirement funding system, but that's by no means universal, and it's a discussion that each country needs to have. The third thing I'd say, Liz, to your final point, is baby boomers have had a reasonably good ride through life in accumulating home equity, not like the First World War generation or the Second World War generation. But women baby boomers have been in and out of work, they've been underpaid, they live longer, and they usually have less savings at the end. So I think it is actually quite a gendered issue. Male baby boomers have had a pretty good ride. Yes, people have got divorced and have had insults, but as a generation, women in retirement now have a set of challenges that we need to acknowledge.
Couldn't agree more. Yes, absolutely. Anybody else want to chip in there before we move along? No. Okay, so what I'd like to do now is just ask some questions of each of our panel members individually before we break into a more general session. So I'd like to kick off with Lisa, who's going to give us a bit of a New Zealand perspective on reverse mortgages. So welcome, Lisa. And could you just perhaps start by saying, Graham's given us this some ideas around perceptions of reverse mortgages from some of the research that he's looked at and done. So why is it that people, do you think, have a negative view of reverse mortgages?
Yeah, look, I think there's a few reasons for the views on reverse mortgages. Some of it just being international coverage of poor customer outcomes, which I would point out actually has not happened in New Zealand. But I think also, and I feel everyone will agree, it comes down to the awareness education and understanding of the product in New Zealand. So although there's still that large lack of education and awareness, I think there's several aspects in people involved in the various industries that are supporting the product, helping with education, and just allowing customers to make a more informed decision with the right information. Right, so that reflects in Heartland and the increase in business we've experienced in the last 4 months. As you mentioned, Liz, the amount of inquiries have increased 70% in the last 4 months over this time last year. So although people don't necessarily want a reverse mortgage, they absolutely want to live a more comfortable retirement. So I feel it's a matter of raising that awareness level, providing really good education so that they can understand their options and have the right information.
So could I just ask, it seems to me that in terms of creating that awareness or education, financial advisors probably have quite a key role to play here. Would that be true?
They do, and that role's been increasing over time. And again, through education awareness, their customer base aging, the bank of mum and dad. Quite often, our customers want to help their kids now. They don't want to wait. They would like to help them get into that home. And again, as long as it's an informed decision, that is a real option that is occurring.
So do you think financial advisors themselves are schooled up enough on this topic?
Oh, look, I think they've done a great job. We do get, and I know it's different in Australia, but in New Zealand, we see an increase in our inquiries from advisors, and that's again ranging from customers who want to help their children now to the customer actually due to new regulations not being able to get a standard loan. To the aging customer base that advisor has. So yeah, it's been very interesting and very different dynamic from Aussie and even America, but we've definitely seen an increase in the role that they play.
Right. Now, if we can just focus in on interest rates for a minute, because I know, one of the things that I've certainly heard over the years is, a question around why are the interest rates for reverse mortgages so much higher than a normal bank mortgage? That doesn't seem fair, people say.
Yeah, and look, that is a very common question. And you have to think about the profile of a reverse mortgage. We're not asking for repayments to be made during the life of the loan, although obviously a customer can. They're not required to ever make a repayment. They can live in the home as long as they choose, which means the loan has no term as a standard mortgage does. So this could go for 20, 30 years. And there's a no negative equity guarantee. So they're never going to owe us more than the net equity sale proceeds of the home. So you've got some guarantees on a reverse mortgage that are going to impact its risk profile, increasing the interest rate. And I think, Liz, let me just point out too, the compounding interest is a factor to consider on a reverse mortgage, and that's why the education process is so important. Mm-hmm. I think every customer should carefully consider that, get that projection, see how that interest is going to grow, and compared to their increase in equity, because you've got that property growth that also offsets that. So very common question, but yep, again, with education and an informed decision for a customer, that's the most important aspect of that, I think.
I've just got a question here, while we've got you on the talking. If you've got a mortgage in place now, can you still get a reverse mortgage? How does that work?
Yeah. So, and I try not to talk too much, but it is interesting because when I first arrived back in New Zealand, we did very few reverse mortgages where we paid an existing mortgage. And that has actually evolved where we now can repay that existing mortgage, making the assumption that we can lend enough to repay it. We actually can repay that mortgage and remove that payment from the customer's monthly expenses. So we can free up that monthly income for them. So we can't allow that mortgage to stay in place. We do have to repay it.
Right. Okay, thanks, Lisa. So we'll come back to you with some more questions later. I'd just like to now invite Josh to give us a bit of an Australian perspective. So tell us what's happening in Australia. Do you see people staying at home more and more as they age? Is this a bit of a trend over there?
The Australian situation, I think, is broader than the New Zealand situation, and it's not entirely focused on reverse mortgages. It's focused on home equity and retirement funding and housing, which I think is the right breadth of conversation to meet a bigger national need. Some of the conversations that Graham had before, people understand reverse mortgages about 15 to 20 years ago, and they're very differently regulated. So the term is very much associated, and the awareness of the term, with prior versions of the product that did have various product features and problems that are understood. So awareness is key of the current customer protections, but also the current availability of home equity in a variety of forms. Australia's got the world's best regulation and customer protections of reverse mortgages specifically. It's also got a much broader approach to the pension loan scheme, a government form of home equity access, partial purchase, partial sale of your home to access home equity, downsizing as part of the continuum of home equity, not just at retirement, but at various stages in retirement. And then, of course, retirement funding and retirement housing and aged care. We've just had an aged care Royal Commission. So I think home equity as housing and funding for retirement is a much broader conversation that gets to a range of different outcomes, a different set of awareness, and also a different set of product solutions. We also see, like Lisa, very strong growth in people accessing their home equity in Australia, and I very much agree that the imputed or real interest rate on accessing home equity, however you do it, is higher because you don't pay current interest. You've got a set of customer guarantees that cost providers more to raise the capital to deliver to retirees. So Australia's got $1 trillion of home equity already saved by Australian retirees. The median household in retirement in Australia has 3 to 4 times as much home equity as they do in superannuation or other savings. And that's a staggering amount. Australian retirees at a median level have just become the wealthiest in the world, wealthier than Switzerland. But most of their home equity, like Kiwis, is tied up in home equity. New Zealand has probably even less superannuation and even more proportionate home equity, and they don't have a means-tested pension. So I think the ability to use home equity to solve for New Zealand retirement housing and funding is huge, and it's yet to be met. Heartland's doing a great job, but there's a bigger national conversation that home equity can start to play a role in.
So what are the things that New Zealand needs to learn from the Australian experience? Because, you're probably possibly a bit further down the track than we are in tackling this problem.
Well, look, I'd point to the Retirement Income Review last year, the Federal Retirement Income Review, the new Retirement Covenant. There's an upcoming review of financial advice and the Aged Care Royal Commission. So you've got 4 major bodies of work in Australia on the back of 30 years of building a superannuation system that's now at a total of $3.4 trillion of assets under management. And even with a maturing but not yet mature superannuation system, which for baby boomers is inadequate, they haven't been in superannuation long enough to accrue adequate balances for their longevity. Even in that context, the Australian government and national system has recognised in those 4 different areas the need for much wider financial advice so people can get better information and become aware of their options. And the second part of what's happened in Australia is the need to include home equity as part of the options facing almost all baby boomers who have home equity, are homeowners, and are asset-rich, cash-poor, and have most of their assets tied up in their home. So there's been a national conversation in Australia about the role of home equity in housing and funding. And now it's up to us to roll out a range of different awareness campaigns and product solutions that can deliver. It will be more expensive than a forward mortgage, but it will be absolutely essential to provide that housing and funding. So that conversation, you can see the answers to our aged care funding are included the clear prospect of using home equity, not just to provide in-home care, but long-term housing as most appropriate in people's homes. That's where they want to live, and then also fund that journey in-home through life. So we have had the beginnings of a national conversation around widespread awareness, financial advice, home equity access, and structurally using home equity to complement superannuation and the government pension. And I think that's a conversation that this panel is starting, but other countries need to catch up on.
Thanks, Josh. Are there any implications in terms of housing supply? You know, I mean, people want to stay in their own homes for as long as possible, and this is one way in which they can do that. But does that sort of tie up housing stock? Does that cause implications, you know, for other people in the housing market if these people are staying on?
No, let's put that to bed, Liz. There are a very few minor impacts of this that economists could dream up in theory, but the reality is retirees want to stay at home and it's the best place for them and they know it. And they're very savvy about managing their finances and their housing to mitigate the key risks they face. Some people have said retirees are taking up housing and they should free it up for young families. Now, actually, the economic disutility of retirement housing is low. Retirees are using their 3-bedroom homes for home offices. They're doing paid and unpaid work in the community. They're having grandchildren around and doing a lot of care. Most importantly, most retirees don't want to downsize because they know there's no local stock where they can get a significantly cheaper property and stay in community. And we've learnt from Australia, from New Zealand, from Japan, that you can flourish in retirement if you maintain thriving relationships and a connection to your community. And people know the value of maintaining those right through retirement. It's not just having your butcher and your physiotherapist around the corner. It's knowing your place and having meaningful relationships there. And that's a value of your home and your community. So the idea that we should expect many more people to downsize in the current structure of our communities and the current structure of housing is not going to happen in time for baby boomers to continue to maintain home ownership and their desire to rent. There'll be a couple of marginal things, Liz, that will happen. Some people may stay home longer than they might otherwise. Mostly, they'll stay in homes that they've been able to renovate and that are fit for purpose for their own retirement. You can also transport any form of home equity access to a downsizing property, so it won't change the market for downsizing. To Lisa's point, it may slightly enhance the ability of the next generation to get into property. We also see Bank of Mum and Dad principally for first home buyers deposits. Those effects are marginal. The major thing, you have more money that'll stimulate the local economy because retirees spend their money locally, and it'll help those communities thrive.
Cool. Thanks, Josh. Now I'd like to move along to Ralph and ask you some tough questions, Ralph. How about that? So, New Zealand has really just one approach to home equity release, and I understand you are developing an alternative model based around home reversion. So, what is home reversion? How does that work, and how does it differ from the standard reverse mortgage model that we have currently?
Certainly, Liz, and thank you. We'll approach the question in 3 ways. First, I'd like to give a bit of context to our answer, then just talk to some of the languaging used in this space, and lastly, as you've asked for, Liz, illustrate a couple of models that we've been working on and considering. Firstly, in terms of context, as you know, our specialty place is retirement income. So when you're talking to people about retirement income, you can't avoid not considering home equity. It's such a big part of New Zealand retirement assets. So naturally, it's something we hear a lot about. And in the context, though, not of purchasing a new car, going on a trip, perhaps provisioning for a medical event, but specifically as an income replacement possibility, i.e. can we use home equity to generate a pension? So that's kind of the angle we're coming from. As we've looked at home equity, I think Josh calls it out well, that's where you start. It's home equity. Then there's a number of things and words around that will sort of come to play in the marketplace, home equity release, reverse mortgage annuities, reverse mortgages, etc. I think the starting place is home equity. then from there are a number of applications of home equity that a homeowner can use to unlock that equity. And they all have different attributes and for different life cycles for a retiree and for different needs in retirement. So we've tried to say, okay, let's look at home equity. What element of home equity can be applied to the homeowner's need, and then find the best possible application of a release for that. So in that context, I think the two most relevant terms are effectively the reverse mortgage. I think we all know what that is. It's a debt instrument. In other words, the homeowner continues to own the home right throughout the period of the contract. They've simply just mortgaged it and deferred the mortgage and interest repayments until they either move out, change their mind, or they pass on. Pretty simple and straightforward. Another model is the home equity release model, which is the opposite. In other words, the homeowner sells a portion of their house and they no longer own all of the house. For example, they might sell X percent, say 3.5% of their house each year for the next 10 years. So after 10 years, they've sold 35%, they retain 65%, and during that 10-year period, they may have swapped the equity they've sold for a regular fortnightly income. So if you want, the simplest sort of definitions, I think, is debt or equity, or full home ownership, or partial home ownership, in the two models that we're looking at today.
So how do people go about comparing your approach with the traditional reverse mortgage approach?
Yep. Back to sort of Josh's comment, if you start with, okay, I've got my home, I've got some equity in my home, then it almost becomes a financial planning question, really. What do you want to do with that home equity? Is it a lump sum? Is that best for you? Is a pension of a regular fortnightly income better for you? Once you've established what your real need is, then the next step is, how do I attach to that need the best way to release the equity in my home? So I think the comparison comes firstly from, is it lump sum or is it income?
Right. So again, we'll probably have some financial advice components in here, don't we, to assist people, comparing the options that are available and what the impact is for them?
Listen, completely. I think the process begins with a good understanding of the homeowner's assets and their financial position, and a really good sense for what the future looks like. The difference in behaviours between someone who's 70, 80 or 90 are immense. So I think it begins, Liz, entirely with sensible financial planning in the moment and in the forward position. I think also legal advice and having the family involved are fundamental. Financial, legal and family counselling are a critical part of onboarding.
So can you just tell us why you've chosen to go down this route? What's prompted you to come up with an alternative model?
Yep. Haven't sought out an alternative model. If you're in agreement that it begins with the best application of home equity, we've said, what's the best application of home equity to a homeowner who's seeking a pension? Both models can do that, and both models have great attributes. We're trying to take the best of both models to play to a demand for a pension as opposed to a lump sum, which has led us down a slightly different route.
And how well received do you think this new approach will be in New Zealand?
We've been doing surveys and focus groups up and down New Zealand, and I think it might have been Lisa who pointed out before, and entirely agree with her. We found communication and misunderstanding everywhere. Some of the terms we talked about before, reverse mortgage annuity, home equity release, it's just too much to ask for people to understand these terms. So, initial observation is people we talked to did not really understand. The communication gap was huge. So I think the challenge for us will be able to communicate the differences clearly and succinctly, and try and help people understand how to match what they want from the equity in their home with the best way to receive it.
Cool. Thanks, Ralph. So I'd like to now just open up into a more general discussion and perhaps answer throw up some of the questions that we've had come through. Graham, would you like to perhaps just kick off while I'm sort of sifting through these questions, and just to offer some comments, having heard what you've heard so far today, do you have any additional insights in terms of, what our markets here need to be mindful of?
Yeah, sure. I think looking through a lot of the literature, it boils down to three key things for me. And one of them's all around asset-based welfare. Secondly, about intergenerational sort of life course, life cycle issues, and also inheritance as well as the third issue. And so asset-based welfare sort of echoes some of the questions that we might touch on in a second, and those concerns over housing, using housing and housing markets as wealth for retirement, and the risks that are attached to that in the broader economy. There's also, at an individual level, we hear so many stories of people saying that their house is their pension, et cetera, but there's concerns over that. And within the asset-based literature, asset-based welfare literature, it's this thinking of using housing wealth in retirement, and part of that retirement and enjoying your retirement, as Josh referred to, is your health. And if using reverse mortgages or similar products as an alternative to public policy and health policy is something that probably needs to be explored more deeply, because it isn't a substitute, I would say, in broader economic terms. So that's the sort of the asset-based welfare stuff. Secondly, in terms of, we're not just talking about generations, we're talking between generations as well. And it's the life course of the child and parent that needs to be thought through, especially if we're transferring equity and wealth. So it's issues over that between generations as well as generations themselves in terms of passing on wealth to fund retirement through these particular products. And then thirdly, that mention of inheritance and leaving stuff to kids. And people see in the literature, one of the major barriers to equity release at an older age is younger generations' expectations of receiving an inheritance, especially if their parents are homeowners. So the issue of inheritance, there's always the spectre of inheritance tax, death taxes, and the media jump on this sort of stuff. And it's obviously quite politically difficult to consider these things. But I would imagine this piece of the puzzle here in terms of reverse mortgages playing right into that idea of inheritance and how wealth is transferred between generations. So there's some sort of points that might lead into some of those questions, because as an academic, I suppose we're critical friends to this. We're trying to sort of see where the challenges and the critique is to what these products can provide. And a lot of people are going to be saying, well, this isn't, as I said at the start, it's not a substitute to public welfare. So I think that's some caution that needs to be baked into the conversation.
Thanks, Graham.
Liz, if I could just respond to a couple of those things. That academic literature on those three fronts is historically looking and doesn't look ahead. And the recent reviews and Royal Commissions in Australia have tried to look ahead rather than back. Home equity isn't welfare, it's private savings. It complements whatever government provision of risk, compulsory superannuation, public savings and pensions. So the language around asset-based welfare does intersect where assets and income tests determine welfare. But this is very much private savings and private wealth. And conceptions of welfare when you're talking about someone's home are not broadly useful to people considering and generating understanding and awareness of this. The question is, generational things have changed in the last 30 years demographically, so that those issues have to be considered and reconsidered very differently than the prior academic literature. 30 years ago, people in Australia and New Zealand and around the world died in their mid-70s, leaving their children with a bequest that was meaningful to either get them into their family home, pay off their mortgage, or get them into their first home. It's meaningful for the grandchildren in helping fund educational expenses, because those second and third generations were at that point in their lives. That has changed, and the bequest literature around reverse mortgages is yet to catch up. If you're 65 in Australia and New Zealand, you will live well into your 80s. And as a couple, you'll need to plan to live until one of you is 90. The 25th percentile, 75th percentile, if you will, depending on which way you go, will live till 90. So you need to plan, and you might live longer than that. And how you fund and house that is an important question. But by the time you die, your children are likely to be in retirement too. We will have two generations in retirement. And if you leave a bequest to a 65-year-old, it does very little for their life. Their family home, and does very little for their children, your grandchildren, because they've already got the biggest asset they've got, which is their education and lifetime earnings, set without the investment that a bequest 30 years ago would have made. So we have to recognise the demographic shifts. The bank of mum and dad, investments in your children's first home, investments in your grandchildren's education are the best investments family units over multiple generations ever make. And they are facilitated, not reduced, by the intergenerational transfer of home equity and, on the flip side of that, bequests. So we really have to look ahead to how home equity can play a major role in funding and housing an ageing population, not as welfare, but as private wealth. And we have to look ahead at the underlying demographics, the bank of mum and dad, and the opportunities that opens up. Those two big issues have to be forward-looking.
Thanks, Josh. That's a very good point. Yeah, and I certainly find that these days people are not really concerned about leaving behind a big inheritance for their children, and they're much more willing to help them perhaps during their lifetime. Okay, we've got a question here I'd like to throw to the panel. The question is, we've had KiwiSaver in the public domain for 14 years, and as an industry, we will struggle with public understanding last year's volume of switches, for example. How would the panel suggest we include reverse equity mortgages in the financial education of the public? Anybody like to take that one up? How do we educate people on reverse mortgages as a solution? Any volunteers? Yeah. Lisa?
Happy to take that one up. I think it becomes in the long-term planning, doesn't it, really? I think to Josh's point, people are living a lot longer, and you've got that KiwiSaver, you might have some savings, but there is the potential now with the ageing population that is not going to be enough. So then is a reverse mortgage at that point something that you educate your customer about and let them know that it is there if it's needed, and that money doesn't go as far as it needs? Does that answer the question?
Yes, I think that's great.
Yeah, I think it's really important part of planning these days. We're going to live that much longer. We all know it's very possible the money that we have put away isn't going to last long enough.
Yes, that's right.
So I think there's to what Lisa said, the surveys that Graham pointed to, people's understanding of the prior products historically, that's no longer the case. The protections that are universal for most forms of home equity access need to be communicated. Firstly, we need to say most Australian and New Zealanders have most of their wealth tied up in their home. Just acknowledge that. Financial advisors need to understand the value of the home and that people can now access it. The second big thing that's changed that is still very poorly made aware of is you can access your home equity and remain living in your home. Your home equity is both housing and funding, guaranteed. Very few people understand. They think it's either your home or you're accessing your equity, but not both. It's now both. And we've got to get that message out. Thirdly, we've got to do what Ralph said, which is to say there are a range of ways you can access your home equity safely. Up to you, have a conversation with your financial advisor. But the idea that people have home equity and they can have home equity as housing and funding, we're still not there yet. And it's fundamental to making sure people can understand the wealth they've got, the access they have to it, and then what they want to do with it.
Liz, if I can just contribute to Josh's comments, our conversations are with retired people, so not KiwiSavers. The conundrum around educating younger people about home reverse mortgages or just equity release, I don't know where you start there. But what we have observed in talking to retired people is the tone and nature of the conversation. It talks about assets, income needs, and the future. And the house is very much the last thing discussed, and it's almost the bottom of the cliff solution, which is just entirely wrong. It should be part of the discussion at the beginning. So I think communication of the benefits of home equity release start with the first conversation, and it doesn't become the result of a conversation as a solution for a problem. It's part of a positive answer.
Right. Okay. Thanks, Ralph. Look, I've got another comment in here on in the chat section. So, are higher mandated KiwiSaver contributions part of the answer, or do we just rely on booming property prices as the long-term answer for quality retirement. And so again, it's this balance. It's recognising that there is both, savings in the home, equity, and outside that. So how do we get that balance right? And should we just be telling everybody to really increase their savings into KiwiSaver? Anyone like to have a go at that one? Lisa?
Well, I do think it's a balance. It's all good to say that put more away, increase that amount, but that person is still managing their lifestyle and living their life, and they're going to need funds to do that. So I do think it's a balance, and it is about options. And again, to Ralph's point about offering all those options and keeping them balanced. I think that is. It's good to say that, and that is a good intention, and that would be ideal. But again, I think a person needs to be educated in all their options.
Anyone else like to add into there?
Yeah, Liz, Ralph, I'm not sure the lost generation is the right term, but New Zealand Financial Services for the past 10 years, almost since the KiwiSaver started 2007, has been absolutely dominated by the saving word. And increasing savings rate will result in a better outcome and a better retirement. And I think we all understand that. But what about the 600,000 New Zealanders who are older than 65 today? It's too late, really, for that KiwiSaver conversation for them. They need help now. And there's a huge proportion of them, all they'll ever have now and in the future is their home, NZ Super, and a small amount of cash. No one's talking to those people.
Mm-hmm. So there's another comment here. Someone's saying, I'd be very concerned if we start suggesting people rely on increasing property prices to fund their retirement. Are we in danger of doing that if we're promoting home equity release and just saying, just don't worry about your KiwiSaver, just rely on what you've got tied up in your home? Again, it's that balancing thing. Would that be right?
Yeah, and Liz, I think we need to point out that most customers are drawing down a small amount. So a very modest amount can make a huge difference to their retirement. So, for example, our average loan or initial drawdown in the last 12 months has been $67,000. So I do, again, that sort of smaller amount can make a big difference, and just looking at your future needs and not taking large amounts up front and relying, as they've pointed out, on that inflation.
Right. Now, what have we got here? Let me just see. Okay, another question here. Anecdote from 5 years of monitoring work in retirement village industry. I ascertained that the vast majority of retirees considering their options, including reverse equity, stay on home or not, did not have strong moral duty to leave large inheritances. Very surprised about that. Is that the understanding of the panel too? We have kind of touched on that, haven't we? Are there any other observations around that, people's desire to leave a large inheritance?
Very anecdotally, Liz, we talked to 40 groups of 10 last year, different age groups older than 65, and that was exactly our experience.
Right. Well, if people are staying in their own homes, they have to maintain the property. New roof, paint job, whatever. Is that likely to eat up some of the cash flow that's being released?
Look, 49% of our customers use the funds for home improvements. It's a big need, right? And that keeps them in their home. It keeps them healthy, keeps them safe. And they're exactly what they're doing. 1 year it might be the roof, and the next year it might be outfitting the bathroom because they need, the right fittings. So, yeah, again, high use of a reverse mortgage or any sort of equity product at that point.
Right. Any very quick final thoughts, because we are running out of time? Anybody like to just chip in with anything that's top of mind?
I just had a couple of final pointers, really. I think the key thing at the top here is this sort of knowledge of the product. I've been doing some of this research I've been doing with UK friends in academia. They did a test case of reaching out to seeing inquiring about taking on a reverse mortgage, and the amount of predatory junk mail that followed, he was astonished by. So I think there's a real lesson there that we can be learned, in how these are perceived and the nature of that sector. Secondly, sort of points around positivity of using these particular products. People saying, well, if it's no burden and of benefit, what's the issue? And that's going to be different for different people. So, and that relates to sort of the third point about, if it isn't perceived as negative, and it might even be in a real sense negative, is it negative for whom? I'm sure more debt is good news for some people, particularly bankers, for instance. So we need to sort of think about, well, what are the positives, negatives, and neutral considerations for whom? For which particular groups we're talking about who might benefit from these particular products. So it's sort of thinking about who's benefiting. And finally, a lot of the reverse mortgage stuff is largely on the demand side if we're talking about housing and the housing crisis. And it'd be interesting to see how some of this reverse mortgage conversation on the demand side can be fed through onto the supply side. And we start to feed through ideas around retirement villages on the supply side, and how potentially, and this is a rhetorical question, how you can maybe meet the needs of the benefits that are generated from a reverse mortgage, and how that could potentially feed through onto the supply side and people taking up other different properties, such as living in a retirement village. So it's how we can sort of make this, okay, you're stimulating some equity on the demand side. Could that be fed through into the actual real needs of people in housing, and whether that can feed through into the retirement village? Because at the moment, that would be perceived as a conflict in terms of the reverse mortgage product and the retirement village product. So it'd be interesting to see in the future how those two supply and demand issues can meet in the middle.
Thanks, Graham. Look, thank you very much, panel members. I'd just like now to hand over to Justin Fox from Trustees Executives to give a formal vote of thanks to our panel. Thank you.
Hi there. I'll just get my camera going here. Sorry. Can you hear me okay?
Yes.
Excellent. Well, first of all, I'd just like to thank, the FSC for putting on these talks, which are, extremely popular, and of which Trustees Executives is a proud sponsor. I'd also like to thank the wonderful panel of speakers today who are absolutely superb, first class. I haven't heard a lot about reverse mortgages for many years, and it's been a real education over the last hour. Just a couple of high-level observations from me. I think everyone deserves to have a peaceful and happy retirement without the burden of financial constraints. And I think it's great for people to be able to access their home equity and fund a decent lifestyle and be comfortable in their retirement if they have to be. I think also, as this has been mentioned, but believe in the ongoing financial education and lifting greater awareness is important for people to understand the benefits of reverse mortgages. And I'm not sure if that is prevalent. People really do know that much about it in order for them to make the right choices. But I think that's all from me, really. But I just want to thank everyone for today. It's been great. Yep.
Thanks, Justin. And look, we haven't got to all the questions that came through on the chat, so apologies for that, but we just simply ran out of time. I'm sure any of the panel members would welcome, if you want to contact them directly, that I'm sure they would be able to follow up. And just a reminder that we've got some upcoming sessions. So 30th of November, we've got a session on Why Does Money Matter, which is a school video competition winners ceremony. And on the 3rd of December, Winning the Battle for Trust and Confidence in the Advice Business. And yes, I can certainly relate to that one, having been out there trying to do that for the last for 20 years or more. It can be tough at times. So thank you very much indeed for joining us today. Great session, as I knew it would be. Fantastic contributions from everybody, including our audience. Thanks very much indeed.
Thanks, Liz. Fantastic. Cheers.